Hello, everybody. Welcome to this week's Fireside Chat. My name is Coburn Sheppick. Always happy to be with you guys. So for today's discussion, we're going to be talking about, which is a hot topic right now, especially in the very uncertain environment that we're in right now in the economy. And that topic is which commercial real estate asset class is at the most risk of a hard landing. And this is, again, based on our opinions, based on the data, based on what we've seen historically, and based on what's been going on with each of these sub-asset classes. And again, I want to just disclose, we're looking at the data and we're making assumptions based on what we see and based on what we've experienced. And so please, understand that the opinions here discussed are not by any means facts. We're making assumptions based on what's going on in the market. So let's jump into our topics today. Again, which commercial real estate asset class is at the most risk of a hard landing? So what we want to cover, I want to just do a brief introduction on Dovetail. And then we'll dive into a little bit of the state of the market. And then we'll get into our topic here. And at the end, I want to give you an exclusive invite, which I'm excited to share. So a little bit about Dovetail. Dovetail is a private investment firm that makes principal investments using its own capital and capital raised from outside sophisticated investors, primarily into commercial real estate assets. We aligned with seasoned operating partners to strategically place capital and leverage our expertise to structure the risk away from ourselves and our investors. We work with established and evolved investors who are attracted to investing alongside some of the world's best real estate operators and sponsors to insulate their wealth and reputation in this crazy, uncertain world. So a little bit about our investment, typical investment profile. We're always focused on growth markets. Both on the acquisitions and development side. We're more so on the opportunistic side, and we're biased towards Class A assets, core plus type of deals, and then we're preparing always for potential distress, which we've talked about in the past. These opportunities that are starting to present themselves and that we're going to be entering over the next period of time into next year, only happen once, very few times in a lifetime. And so we are preparing for what's to come, and we'll get into that a little bit later. Our average hold time is 5 to 7 years, which is pretty typical in the commercial real estate investment space. So let's dive into the state of the market. So the Fed has obviously been rapidly raising interest rates. We're up 375 basis points year to date, which is again one of the fastest periods of rates of rate increases. And this is all to combat the crazy inflation that has been occurring, and it affects all of us. It affects our buying power. It affects the way the economy functions. And so just as of a couple of days ago, inflation was, the October inflation data was released, and it came in better than a lot of us probably expected. I think it clocked in at 7.7 year over year, from 8.2, which is a solid number to see. And what that tells us is the Fed's pressure is working. Now, if you dissect the data, where the numbers are being reduced is from mostly goods and services. But if you're looking at shelter and rents, it's actually gone up. And so we'll talk a little bit about that more on our main topic later. So the housing market, which is a huge factor in in the economy, of course, and we're not talking about the housing market, but it affects the market, it affects the economy. And the housing market is absolutely at a turning point. So there's you're seeing it, all over the headlines about how much, not only on the lending side, but on the actual selling side and values are reducing. Loan applications are down off a cliff, and those in the lending space and the brokerage space are in for a very, very tough time. And we're now starting to see layoffs. Some of the big tech companies who are going through a tough time right now are laying off thousands of people. We just recently saw what's going on with Twitter, what's going on with Meta or Facebook. Thousands of employees are being laid off. And so again, we are at a major point of a risk of a recession. And in listening to the Fed's last meeting, Powell speak about, where are they going to pivot? Where's their attention? They do not want us to enter a phase of what occurred in the 70s. So they're going to keep the pedal to the metal, if you would, and make sure that they get ahead of this thing. And it sounds like and we all have this feeling that it's a little bit too late, even though they're aggressive, and some people think they're overly aggressive. They want to make sure that they get ahead of this problem of inflation, so we don't go through what we had gone through in history. And so what we expect is the Fed will sort of soften up their ease off the gas a little bit as far as raising rates. We expect another probably 50 basis point hike on their next meeting, and then even more hikes in Q1 of 23. Probably likely smaller as what they're doing is putting pressure, and with these the amount of layoffs. So what they're doing is working. We think rates will continue to rise in the short term. Like I said, another 50 basis point rate hike is likely, and then maybe a few 25 basis point rate hikes after that. And we do expect the NBER to call a recession sometime next year, early next year. And a lot of people already think we're in a recession, which is, like I've said before, defined in a little bit of a gray area right now and in today's world. But that's where we are expecting things to go in the short term. So let's dive into our topic today of which asset class is at the most risk of a hard landing. And again, we're looking at what has happened and what's going on with the smart money and with the risk taking that's been occurring over, especially in the recent years. So I want to start with a big subject, big sector here, which is office. And office has been, depending on the market, before we get into this, when looking at this macro data, it's even more important by taking an understanding of what's happening at a macro level, but everything is based on the demand drivers within a micro area, within a sub-market. And so what we're talking about just macro level here, but this is not going to be the case for every every market by any means, and we know that. But starting with office in the major markets where office has historically been one of the biggest types of assets that have big demand drivers, like New York City, like San Francisco. In these types of markets, they have been extremely hurt. These assets have traded at top dollar in previous years because of the demand for this amount of space. And COVID-19 pandemic obviously pushed us into this new work environment, and so that has already, prior to the state of the economy today, with interest rates rising and the risk of a recession, office has been a very, very hurt sector. And so, office is driven by workforce, and that landscape has absolutely changed, and we think it'll be changed forever. For one, as far as location, people, work and live in more secondary markets. There's less demand for these central business districts as far as people coming to work. And we think that the work environment has changed, and it will be changed forever. But then we see what's going on with Twitter, as far as Musk is demanding people to go back to a traditional workspace, 40 hours a week in the office. And so I think we'll see some big shifts as far as, and that is a special case. He's turning around a company in a very, very tough time, in a very hurt company. But I think, we'll start to see more of that sort of putting the foot down to get the workforce back in the office. Now, there's more sectors here that are not on the screen. If you're looking at the screen, like hospitality, like shared workspace, for example, WeWork being one of the leaders in that space, where there's still, there's still good demand for that shared space, because people still need a place to work. But the amount of square footage that companies need is being reduced. We just saw, Facebook or Meta back out of, a massive lease in Austin, Texas, which is one of the few markets that are turning in the wrong direction, or leveling out. And so office is at major turning point. But there's still going to be demand, depending on the market, of course. Let's jump over to retail. So retail is one of those asset classes that a lot of people shy away from. Most people are looking at multifamily or industrial. Retail is one of those things where people think that retail's dead, and that's just not the case. Retail is actually performing very well, and it's aside from what just happened with the pandemic, that we're now in a new place from. That's in the past. Retail's performed well, and even though we have more e-commerce and you'd think that there's not as much brick and mortar demand. That's just actually not the case. And so what we're seeing is, because of the tenants in retail spaces, sort of the single tenant, triple net lease type of assets, these are credit-worthy, stable tenants. And that makes the investment stable. And so we are now seeing a shift of capital from these more value add type of projects, mostly in the multifamily space, where investors want stability. Investors want fixed income right now because of the uncertainty that we're in. And so I think we'll see retail continue to perform very well, although consumer demand is going to fall. Once we're in a recession, people cut back expenses, people cut back spending. And so there is going to be that level of uncertainty in what will happen. But retail, we're already seeing more capital being allocated to these more stabilized type of tenants. Now, just to put that into perspective, if we have the choice right now to invest, I mean, tenants are everything, right? So if we have the ability to invest in an asset where there's a very creditworthy tenant, meaning like a corporation that has a massive balance sheet, called Amazon, or you have renters that have forked out massive percentage of their salary to the rent in multifamily. At this point in time, we would choose the more creditworthy tenant. It's more stabilized. It's more stabilized opportunity right now. And same with industrial. Industrial is one of those asset classes that have historically been the least glamorized, but as of in the new world, especially over the last decade, and it's just getting even more of a demand because of the way that with e-commerce and the way that goods are fulfilled and distributed. Industrial is performing well, and it's something that we have our eyes close on. There's certain markets that are lacking industrial demand, and we think that asset class will continue to be focused on by very smart money. And so we would put this in this category, the same category as far as continuing to perform at a strong level like retail. Now let's talk about multifamily. Multifamily is historically been an asset class that produces good returns, cash on cash returns. People like multifamily. For some reason, a lot of people, I think, with some of the big influencers, the big 10Xers, people like multifamily. And there's many good things about multifamily because people always need a place to live. That's what everybody says, right? And so multifamily has historically been a great investment. But what we've seen, and we were looking at deals, multifamily deals, we always are, but in 2019, there was a big shift, and things, value-added type of deals were being traded in the fives, in the 5 caps. And if you know real estate, that's overpaying for an asset. And so what has happened since then is there's more risk taking from operators and from sponsors. Most of them are newer operators, inexperienced operators, taking on the risk of a value-added multifamily at a 4.8 cap or something crazy. And so this is insanity. So these types of deals have doubled and doubled and doubled over the last decade. And aside from this overpaying, and talking about the economy and talking about where we're at with rising interest rates and pushing our domestic economy into a recession, who is most affected by what's going on, and that is in a lot of cases the people that rent apartments, and so the real uncertainty is, at what point can people not afford the rent? At what point are people going to say, I can't afford this, I can't pay this much? And I think that we'll start to see a shift in that, and we already are. I just was looking at an article yesterday, I think, about the amount of evictions that are picking up, and so I think we'll start to see some real kind of negative movement on the multifamily sector as it relates to renters not being able to afford the rent anymore. And at that point, then we've got a problem as far as the existing deals that have tenants that can't afford the rent. And so that's one side of it. On the other side of it, there is a this value added subject has really been geared toward this asset class, and people, operators that have bid up multifamily value added deals over the past 3 years, that are buying these at a 5 cap or less, or around a 5 cap. They're taking on short-term debt that's unstabilized. They're going to remodel it, and when these, now that rates are picking up at as the speed that they are and the speed that they have been, when these loans come due in a short period of time, and a lot of these are going to come due in the next 6 months, we're going to see a wave of situations where operators cannot refinance, and there's going to be distress. And so we are totally pens down in the short term for real estate, and that's because things are going to get shaken up. And so we want to be totally prepared to enter at a low basis when the bankruptcies start to clear, when the foreclosures start to clear, and we think that that'll likely come in the next year. And so the worst time to get into any deal is when things start to in a way blow up. You want to get in when that's settling down. And so we're pens down for right now, and a lot of people will think that's crazy, but looking at what has happened historically, this is not something that's new. And if you've been in real estate, you know that a lot of these assets have been overpaid for by free money, and those days are over. So just to sum up the thoughts here, industrial and retail, we think, are going to continue strong. In every sector, there's going to be new price discovery, of course, and that's because things have to adjust with the cost of capital, and that's just how the game is. As far as office, again, there's going to be a big shift as far as the demand for this type of space. Shared space will continue to thrive. The amount of the large square footage that companies take, I think, will be shaken up forever. And we're also seeing a lot of potential reuse situations, adaptive reuse in the office space, to mixed use, to residential. I think we'll continue to see more of that. Obviously, development deals are being sort of put on pause right now, but I think that'll pick back up as things really start to burn off in the next year or so. then I think that the repurposing will pick back up, and we'll start to see these types of CBD districts, CBD markets sort of pick back up in a different direction. Multifamily is, we think, at the most risk based on the amount of inexperienced operators in markets that have blown up in value, inflated in value. And obviously there's big demand shifts in certain areas like the Sun Belt, of course, in Phoenix, in Florida, in Austin, where there's been a massive amount of people that have moved into the market, but that's pushed values up to a point that's unbearable. And so we think that alongside the amount of value that's been bid up, as well as the operators, the inexperienced operators that have been involved in these deals, taken on a lot of risks, overpaid. We think that there's going to be, as well as the demand and salaries that people have that have not kept up with inflation, and things are still at very high prices. Inflation is still up. We think that that multifamily is at a major risk point. I hope this brought a little insight to you as far as what we're looking at, what we're seeing, and the way that we're headed. And we are, like I said, pens down. We're preparing for what's to come, and we think that things will start to really come to light in the next 6 months. And we think that there will be a recession, and we think that we know that we're going to prepare to take one of the best opportunities in real estate there's going to be. And how do we prepare for that? One is by having these calls, these fireside chats, because we want to create an integrated community of just like we're doing now, talking about what's happening and preparing for what's to come, and as well as preparing with the operators in our network that have a similar mindset, and again that are strong, that have a track record, that have been through multiple cycles, 2008 being one of them, that understand basis and will be co-investing with them in the opportunities that we know are coming. And so I'll leave it at that. I want to give you an invite here. We are opening up our investor list. If you would like to join these calls, continue joining these calls, of course, or if you'd like to get first kind of noticed, first insight on the opportunities that are coming. And I want to invite you to either one, stay in the loop, email me, or join our investor list so you can continue to join these calls, or even better, if you'd like to go to our website and register for our portal, where you can actually see the types of things that we are looking at. You can do that on our website at dovetailig.com. That's dovetailig.com, or email us, and we'd love to set up a conversation with you, or at least stay in the loop to continue to get updates on the market and any insights that we have to share. You can email us at partners@dovetailig.com. That's partners with an S at dovetailig.com. This has been fun. Thank you so much for being here once again. And we try to have these calls once a week, or at least bi-weekly. So thank you for your time and being here today. My name is Coburn Sheppick. I'll see you next time.